Hello and welcome to a brand new show of Markets and More. Global financial markets have seen a serious price dislocation. The price fall in financial prices is reminiscent of what we saw in 2008. While parallels have been drawn that things are going to get bad to ugly, and we should now really be looking at downsizing our portfolio and protecting capital. But in an environment like this, when it is difficult to gauge what will happen to the world, what policies central bankers are likely to follow, and how the virus will impact individual companies, how should an investor really benefit, maximize, or keep their nerves calm? And that's where I think Sunil will help us and help our viewers based on his experience of market understanding that last time or previously when these instances have happened, how exactly have financial markets acted and reacted. Okay, we all know the bad news. There's no point in getting into why. Let's get into what's next.
So very clearly, this is an event which obviously causes a lot of scare because it has got to do with your health and survival rather than anything else. I would say that the way this event is different from earlier instances is that news flow is like there every second. We are in this world where we are connected. We get to know everything. Rumors spread very fast. Cases are being assessed on a minute-to-minute basis, and I think that is where this fear factor I think is increasing very sharply. Even in India, we had fresh cases, particularly in one city, one group of foreign tourists. But the fact is that suddenly, from 6 cases, we have 25 or 29 cases even in India, and I think that definitely is causing a scare. We have a big festival coming up everywhere. Holi is being sort of curtailed or cancelled, which is again a good move because it's a precautionary move. But I think we are in this phase where markets apart, economy apart, there is now a fear psychosis, and rightly so. As far as global markets and global economy is concerned, there is absolutely no doubt that we are going to have a period of a quarter at least where growth rate will go for a toss because people are not traveling, no one is in a mood to do anything. Obviously, one country which is in the epicenter, China, feeds a lot of other countries in terms of raw material, is a big buyer, and I think 1/4 of economic growth is gone for a toss. At the same time, I would say that the markets have been up there. A lot of markets have already reacted, and for a change, I would say the central banks across the world are also taking unprecedented actions. So it started with the Australian Central Bank, you have the US Central Bank, and one can expect a huge sort of stimulus which can come up as far as the global economy is concerned. But I think the next 15 days in particular is going to be the period where we will know that whether this is subsiding or whether it is going towards a full-fledged epidemic. My view would be that if the second is not true, that if it is not going into a full-fledged epidemic and it shows signs of abating or stabilizing, then the markets are poised for a sharp up move, at least recover to a major extent what they have lost because of the huge stimulus which is coming in.
So a year from now, when we would be discussing February 2020 and March 2020, will that be considered as one of those finest buying opportunities? Because now there is fear, there is panic, there is pandemonium, and like we say, blood on the street.
So Nikunj, very surprisingly so, and obviously we are in a serious situation, and it doesn't make sense for us to
We're talking financial
laughing
markets
about
here.
it. Yeah. But actually, if you go back, we have very short memories. Do you remember the biggest concern which we were facing in the first quarter of 2019? And no one remembers it. No one remembers Mr. Kim, and no one remembers North Korea, and whether the nuclear button is big or small. That also was a concern which could have destroyed the world. But we forgot about it because new ones came in. So as I said, if it doesn't turn out to be a very big epidemic, then I'm very sure we'll have forgotten about it 3-6 months from now. And as you rightly said, particularly in a lot of stocks, prices have come back to the level from where they started moving in. Even companies which declared phenomenal results and saw a 30-40% move up are back to the levels where the results, pre-result sort of prices. So I think there is definitely opportunity. At the same time, there is uncertainty. And I think as an investor, the only thing we can say is that, start nibbling. particularly stocks which you like fundamental basis, you'll never be able to catch the bottom. And there is a fair chance of 80-90% probability that this will subside. Maybe there's a 10-15% probability that this might become an epidemic, but that is something which is not in your control.
Okay, central bankers clearly have followed this approach of we will do whatever we can do to fix the problem, which means more liquidity, decline in bond yields. Because of abundant liquidity, we have seen that money is gravitating towards few stocks and few large cap stocks have benefited. So if the lay of the land is not going to change, are we in for that repeat of 2018 and 19 where 10, 15, 25, 30, 50 stocks will do up?
I think you very clearly know my views on that, and we have spoken about it, and I have repeatedly said that there is definitely a bubble in quality, particularly in that 15, 20, 30 stocks which are trading at very high P multiple. See, ultimately equity investing is all about discounting the future earning potential. And yes, you are right that if liquidity surges and if interest rates fall to such an extent, then P multiples overall rise. But we have also to see from a scenario that there will be a lot of sectors which are right now not in favor, which would benefit big time. Because post the US-China trade war, there was already a move from some companies to move production capacities elsewhere. And in that move, a lot of ASEAN countries were benefiting, like Vietnam and Thailand and Malaysia and Indonesia. I think what this coronavirus has done it has made the whole ASEAN bloc as one, and India to some extent is isolated from that bloc. And I think this move of shifting of production or partial shifting of production will gain ground, and India might stand to benefit. And I think hard assets also stand to benefit, because if there's a fiscal stimulus, almost all the countries will spend a lot of money in pumping up infrastructure, creating maybe more hospitals, I don't know, and that is where the neglected sectors would also stand to gain. On the consumption front, in fact, there is some concern, because if people don't go out, people don't go to see movies, people don't go to restaurants, the celebrations are curtailed, then you might have some of these sectors which get benefited positively getting impacted. But by and large, I think whenever there is a loose monetary policy, interest rates fall, we have this concept of carry trade which comes up. And as I said, it all depends on when this situation becomes normalized. But the moment the situation becomes normalized, if an investor in US can borrow money at 1%, there's a lot of incentive to borrow there and invest in countries where the yield can be maybe 8, 10, 12%. And that is where money can flow back into the emerging markets, and of which India would be a major beneficiary.
So when do you think the good old investing, the good old Sunil Singhania investing, where you buy stocks based on dividend yield, enterprise value, return on equity, and P multiple, when will that classic investing come?
One thing is, you already always said that we are not only value investors, we are opportunistic investors. We also like growth stories. The only difference is that we would buy a high P stock if the growth justifies that high P. You can't buy a 70 P multiple stock growing at 7-8%. You can buy a 40 P multiple stock growing at 20%, because then you justify that. And I think it's a cycle. We have seen multiple times something or the other come up. You have seen the dot-com boom where P multiples used to be 200, 300 times, the power sector, the pharma sector, multiple times. Multinational companies were in favor and then went out of favor. And it's not that all of them are doing well. We obviously name the companies which are doing well, but there are so many companies. You take ITC, Page Industries, Marico, Havells, they're all down, like Gillette, all down 20, 30% from their highs, because growth has not been there. So I think it's all ultimately panning, and it's a 300, 400 history of equity investing. It is not that it's a new theory which I have propagated or someone else has propagated. We have all seen that eventually the price which you pay has to justify the returns you're going to get over the future in terms of future profitability. So I think it's a matter of time, and I think by doing what we are doing, we are able to generate decent returns. So why deviate from it and do what you know and what you're comfortable with.
What are the lessons to be learned from D-Mart? I'm asking not to comment on the individual stock here, but here's a company which goes public, expensive, goes from 600 from the listing day has become 2500, and the QIP subscription is saying the appetite from institutional investors is still there. So what are the lessons for an ordinary viewer and investor to learn from it?
Now, first of all, I would say hats off to the entrepreneurs, promoters, management, including professional management, for having created a great enterprise. In an era where people are talking about online shopping, this is a brick and mortar, retail company, and created so much value. Having said that, I think one thing which you yourself mentioned, that the institutional investors lapped up $1 billion plus of stock. Where were they when the company was listed? So and it was listed at like 40,000 crore market cap, and since the listing it has moved up by 4-5 times. So I think somewhere down the line there is also this fear of missing out, which is coming up in some of these companies. I am not talking about D-Mart. I adore the management. I adore Mr. Damani for being a great investor himself and for creating this kind of an enterprise. But I think right now what we are seeing is a fear of missing out. And there is also a concept of pyramiding which is happening. So investors who own these stocks have done very well because the stocks have done well. And obviously the prospective investors look at their last 1 year return and see that their funds have outperformed massively, and they end up getting more flows, and you can see the flows into some of these funds. And ultimately these funds keep on buying the same stock. So you're positive on a stock at 500, 1000, 1500, 2000. This way investment would have been so easy. You don't have to do anything, just shortlist 10 stocks. You don't need any fund manager, and you just buy and forget about that. It might work, but as I said, ultimately the future profitability will have to justify. At least in case of D-Mart, there is growth of 25%, so you can justify to some extent. But in some of the other FMCG companies, as I said, the growth is 6, 7, 8%. You can't justify a 70, 80 P multiple.
So what you're saying is that if you're getting 15% growth at a P multiple of 40, 45 times, it's still okay. But if you're getting 15-20% growth at a P multiple of 15, then that's the place where you're hunting.
That is what we try to do. So our concept is very simple: 15, 15, 15, 15% ROE minimum, more than 15% profit growth, but less than 15 P.
And are you finding companies like this, which are growing at 15%?
The coronavirus is helping.
Okay.
Yeah, so we were finding that those companies, and then the market did run up, particularly the mid and small cap between October to January. I think this coronavirus has brought the valuations down, and a lot of companies are now again becoming attractive from a medium to long term perspective. Frankly, I don't know what is going to happen in the next 2-3 months, because in a period of fear, normally the safe stocks tend to outperform massively.
Has the coronavirus episode forced you to rethink any of your investment thesis? I mean, for example, if somebody was long aviation, it's time to think again. If somebody was long tourism and hotel, nothing wrong with those businesses, but you have to wait it out for another 2 years. Have you changed anything incrementally in your portfolio?
So coronavirus, obviously you have to take cognizance of the fact that there is going to be some disruption. In some companies the disruption might be very short-lived, but in some companies the disruption might be for a slightly longer period of time. And as you mentioned, one season of tourism is gone, which will impact even the airline stocks. And these are companies which very high fixed costs, because the infrastructure is already there. I was reading some reports which said that Taiwan, 90% of the airline capacity is idle, and in some countries it is 80, 70, 60. Even in case of Indian Airlines, they have all cancelled their flights to ASEAN region, and we should not forget that we have the holiday season just coming up between March to June. So it is going to be tough for a few of these sectors, but at the same time, as I said, we will have to watch whether this epidemic turns for the worse or settles down. So it might settle down much faster, but yes, this impact is going to be there for at least 3-4 months.
On paper, we can say crude decline is great, but we can also say that, look, coronavirus is not going to impact the world beyond 2 quarters. So don't get excited about decline in crude, because if growth will come back, crude will also come back. So let's not pay attention to crude.
I think crude is on a fundamental downturn, irrespective of corona. Yes, corona has only added or hastened the downfall. In fact, Saudi Arabia talked about 1 million barrels a day cut, and still the price did not move at all. I think, Nikunj, what we have to remember is that, we consume 100 million barrels of crude a day, and the production is 100 million barrels. But the source of generation has changed. So US, which was producing 6 million barrels, is producing 12 million barrels, is going to produce 15, 16 million barrels, and there is no cut. It is private companies, they keep on producing. So there is obviously higher supply. And on the other hand, you have renewables coming up, you have EVs coming up, you have technology which is becoming more efficient in the sense that your cars are now running longer on the same amount of fuel. So all this means that structurally, crude is on a downturn. And I think that is going to be long term quite positive for the Indian economy.
Which are the sectors or companies or themes you think you will benefit because of shift in world? A, China because of trade war, now because of de-risking after coronavirus, and C, disruption in supply chain. India will gain. How can investor gain because of that?
So I think there are few very obvious sectors. I think chemicals will definitely gain.
Do you own chemical stocks?
We do own some, but as I said, the valuations were a little discomforting, and in this current downfall, we might be able to find good opportunities. I think pharma has been on a downturn for quite a long period of time, almost since 2015-16. Particularly the US facing pharma companies have not done well. There is still stress there in terms of growth. India facing pharma companies on the other hand have done phenomenally well, where some of the companies having doubled, tripled also. But a lot of these mixed companies like Dr. Reddy and Cipla and Sun Pharma and Lupin, who have both domestic as well as offshore businesses, are getting punished because of their US exposure. But if you just look at their India sales and India business, I think the market cap is not even discounting that. So some of these companies will come back into
the good old Lupins and the Ciplas of the world.
But it is early, but you have to now start looking at them. There are definitely going to be some disruptions because Indian companies were also dependent a lot on China to supply them with the basic raw material. So I think company specific wise, it's frankly, we don't know which company was buying what from China. I don't think anyone has done that in so much detail. So you have to depend on what the company is saying. But I think by and large, this can again be a sector. I would also say that some of the brick and mortar sector, like metals, for example, obviously the metal prices have fallen post Corona because China is supposed to be one of the biggest consumers. But the prices are now like less than half time book for a lot of these metal stocks. And these cannot be structural plays, but I do expect that once the stability comes in terms of this virus, there might be a big bounce in some of these sectors. So you can maybe play for the bounce.
Which are the new age businesses you like? When I say new age businesses, InfoEdge is a new age business, Quest is a new age business. Do you like anything there?
So, I think we do like some of these businesses which are into staffing because, we are becoming more and more, I think, organized. We are moving away from the old age system of, mom and pop stores. There are a lot of malls which are which are coming up. Offices are changing. You have large offices of 3, 4, 5 million square feet, which are all requiring, housekeeping services, security services, outsourced services. And I think this is one business which, even in the scenario where Indian growth has not been that great, they have continued to grow at 10-15%. So I think we are positive on those businesses. Obviously, anything to do with online is positive if you get it at a price which is comforting. But internet is here to stay, digitalization is here to stay, and some of these businesses have like multiple growth trajectory going ahead. I would reiterate, we like the theme which is financialization of Indian savings, and as and when there's an opportunity, maybe insurance company, wealth management company, asset management companies can be great business.
Why is that you don't own them? Because now there's a wealth management company, there are 3 insurance companies.
Let us see, we might get an opportunity.
So what do you like, life insurance, general insurance?
I like both life insurance and general insurance, because in general insurance you have to again go every year, and your client can shift. Life insurance is more annuity. So the stickiness, once you have a customer, if you service the customer well, it is lifelong. So I prefer life insurance than general insurance.
You know, a point which at least I have observed and I learned from market veteran like yours is that best of the stocks they correct. There are periods when a stock like Titan or globally in Apple or Bajaj Finance, they go through patches of 25, 30, even 50% correction. So are we going through that kind of an patch where one should not really consider this as risk, this as volatility, and best of the stocks have I mean, that's markets for you. They will always correct.
These stocks have not corrected that much. In fact, they have not corrected at all. But yes, you know, if you are structurally positive on a theme, on a company, these volatility is largely because they go through phases of undervaluation and overvaluation. So the way, you know, maybe some stocks are overvalued, they might be because of some reason go into a phase where they become undervalued, and I think that is what market is all about. So I don't think we can make a general comment on this, but yes, you know, if the company is good, any opportunity is a great opportunity to load up to it.
So closing comments, where have markets surprised you in last 3 years, and where have you got disappointed also equally?
Markets have surprised in the sense that expensive have become more expensive, and you know, the only thing is when I ask investors who have invested in these companies, the reason, I think the reason I get is ये गिरते ही नहीं है, ये बढ़ते जाते हैं. I don't think that is a good enough reason to buy stock, and then I read the analyst reports, and you know, sometimes it is very perplexing. They say that we value this company at 53 PE multiple. Why 53? Why not 50? Why not 60? Why not 40? And every company has a different you know, prospective PE multiple. So maybe, you know, there is this I would say psychosis of justifying after you have already taken a decision rather than the other way around. So that has definitely surprised that the expensive has got more expensive. I think on the other hand, what we have noticed is that some stocks just keep on getting cheaper and cheaper and cheaper, and there are no buyers at all. I think it's a phase we go through. We went through that in 2013. I remember stocks used to be like 3-4 PE multiples. They're still not that cheap, but they have become relatively quite cheap compared to what the market is. So I think you'll have to wait it down. As I said, you know, when you buy stock, you become partners in the business. So if a company is available to you completely, whether you'll buy it, that should determine whether you buy a stock or not. And there are a lot of now stocks which are trading at level where you won't mind buying the whole company.
So if I have to write a footnote for today's show, can I say that, look, fear and uncertainty always coexist in the market. A year from now, it appears based on previous experiences when crises have happened, if you've bought bad news, you've been rewarded.
I think last 25 years that has been the story. You know, every bad news has been an opportunity. And on a lighter note, you know, if coronavirus were to spread and 50% of the mankind would not survive, then whether your wealth is in equity or fixed income or gold, will it matter, you know, when you're not going to be there? So I think India in that way has been resilient. We have weather in our favor. We have extreme hot weather which is coming up already in the southern part and the western part. We have seen hot weather coming up. It is said, I am not a scientist or a doctor, but it is said that this viruses don't survive over 30 degree centigrade. So that works in our favor. The other thing is mankind has also evolved. What I am also noticing is that the number of people recovering from coronavirus is now more than the number of people who are getting this fresh. So if you see the net affected people are now 42,000. And I think I look at that, whether this 42,000 is increasing or reducing. And at least for the last 5-7 days, you know, China obviously has seen massive recoveries compared to new incidents. It is the newer countries. And as and when they start taking precautions, a similar trend which we have witnessed in China might also be true, where the number of fresh incidents start to come off. But as I said, this is very, very volatile, very uncertain. We don't know. So I think next 2 weeks is going to be quite, I would say, worth tracking.
Well, we live in volatile worlds. What can I say? Appreciate your time and thank you for joining us.
Thanks a lot.
We started coronavirus. We have to end with coronavirus because that's the current mood point.
Hope next time we end with a corona beer instead of coronavirus.
Well, 3 cheers to that in advance, and thank you for joining us. And that's it on this edition of Markets and More with Sunil Singhania.